Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. So as we're winding down 2012 and heading into 2013, what a way to start next year, especially as you're looking at your budgeting, looking at what you think low interest rates will do to your institution this next year, is that I have a book here. Unfortunately, this is the worst-selling book that we have at Seafried and Brew, and it's called The Art of Tax Efficiency for Community Banks. And when you look at the average community bank out there paying about 27% of their pre-tax income in taxes, that is horrible. Our belief, and we put it as being the third driver of performance, is that community banks should be bringing their overall tax liability down between the AMT and the regular tax. Many of you have heard me say it before, but we're still looking at banks paying a huge portion of their income out in taxes. And this isn't tax avoidance. This is what we call tax planning. Think about it in your budget for next year if you could get that number down to closer to 20% in here. What exactly would that do in terms of really driving your income? This came up last week as I was traveling to visit a number of banks. These banks were paying anywhere between 34% and 37% in taxes. So when you look at it, to bring it into this realm, is that essentially it takes a strategy. We talk about it in our book. We have experience working with banks to get you down into this area, and it takes some time, it takes strategy in order to do it. But it used to be at this time of year that community banks would sit there and say, gee whiz, we have too much in earnings. Let's go and look at taking some tax losses. So another thing that a lot of community bankers are saying out there is that tax-exempt securities, for instance, are not that attractive because interest rates are so low. Well, I put together a little Christmas surprise for you, what I call a back-of-the-envelope approach to looking at what would happen if we bought a tax-exempt today, 20 years out, way out on the curve, and interest rates go up. Best thing that could happen to you. And this is the Christmas gift for you. So right now, a 20-year tax exempt at a 343, looking at a taxable equivalent using 10 basis points for TEFRA at right about 5.19% taxable equivalent. Can't get this in the loan portfolio, can you? So overall, you look at it from the standpoint of municipals still being very high yielding out there. Something that I think every community bank that's taxable could put a piece of this type of security into their portfolios and be able to get these higher yields, which offset, of course, the loss in net interest margin that's happening because of so many assets being repriced in here. Well, what happens if interest rates go up? Well, the interesting thing is that let's look at it in a theoretical shock. This security, which right now is trading about par 0.4, which would give you that 343, would then produce a price up 300 down to about 73.36%. Oh no, that is horrible. Well, doing the old-fashioned way is that essentially taking a planned loss in here, that the loss would be $270,400 on $1 million piece of this particular security. When we look at that loss, and taking that loss, is that essentially 34% of that loss is taken by Uncle Sam in terms of its effect. So 91,000 in terms of the tax piece, which would leave a net loss of 178,464. So when we look at it, this is tax planning. by allowing the government to take that portion, leaving you with this net after-tax loss. Well, we then go and we purchase another municipal security. This one would be at approximately 5.41% with rates up that 300 basis points. But once again, tax exempts are not going to rise 300 basis points. So when we look at treasuries in here at a 172, that would put the treasury in here at about a 472, up 300. The municipal would move up to about a 541. When we look at it, is that the taxable equivalent in here would be an 819. So even though interest rates moving up 300, the overall effect in here is that you have much more of an impact of the taxable equivalency on the municipal bond. Somewhat theoretical, somewhat can be argued, but this is what we've experienced in the past, is as interest rates move up, is the tax exempts move up in a wider spread, basically giving you a much more higher taxable equivalent. So now you have an 819 on the books. With that is an increase in net income of 36%. We then look at its effect. Remember, going back to that loss, that $178,000 loss, that then is recovered in 9 years. And then after that, of course, that income increase of $19,800 just proceeds through the next years, adding to the net bottom line. So you take the loss in the current year, then you get the benefits of a higher tax-exempt yield, that extra $19,000 per year. And that's how you build one piece of tax efficiency. So I look at it that interest rates rising can help your overall tax efficiency, help you move forward to building a stronger and higher yielding investment portfolio. Say goodbye to 2012. This is our last webcast this year. We'll see you in 2013, and we're all wishing us a happy and prosperous community banking 2013. There's going to be challenges, but we'll meet those challenges because, as we've done before as community banks, we've not only survived, but we have thrived. Have a happy new year. Jay Brew, co-chairman of Seafried and Brew.